Run in circles, scream and shout.
$40 trillion debt mark made in the United States.
The financial media was all over it.
Man,
How is this going to play out?
That's right.
Right. I would think debt crisis. Well, that's what we're going to cover this week, so stay tuned. This is the August 24th, 2026 Advance Report from McGowan Group Wealth Management, an update each week for our clients. There's several reasons you should subscribe, and we hope to prove it by the end of the broadcast and maybe even get a like. This is Alex Tolene, radiating excellence and brilliance. I'm Spencer. Today, run in circles, scream and shout.
U.S. national debt over $40 trillion. If you listen to the financial media, we're in trouble. We're in big trouble, Cotton.
It sounds bad. Now, this is usdebtclock.org. It's a great source. One of the other sources we tell our clients, which is also free, is the source of tradingeconomics.com.
Yep,
which is up to the minute futures, 5 o'clock on Sunday. If, Iran's popped off or something's happened, then you can find out everything from oil to crypto to the indexes pre-market. Anyway, usdebtclock.org, a great resource as well. Here's your 40 trillion national debt.
Yeah, so what happened this week is you had Treasury Operations come out and say, we're going to hold down the long rate by doing operations, kind of like an operation twist, right? So we're going to buy more of the notes.
That's the 20-year note at a record 5.24, and that 20-year note actually hit 5.3 at the highest.
Yeah,
that's the highest since 2007. And that sounds really bad too.
It kicked off a really interesting rally in gold and Bitcoin and some other instruments like that.
Bitcoin, 77,000 a coin. 23% for the week, and then gold was up 5% for the week.
I think the most interesting thing about this, Spencer, is everybody's talking like, well, we hit 40, what happens next, right? And so when you look at the global balance sheets, what's happening in the world?
Congress is like a bunch of crack addicts. They just can't stop.
They're
over there taking fentanyl and wandering zombies they are.
I would encourage everybody to go look up Triffin's dilemma. Triffin was an economist back in the 1960s, spoke about what are some of the ramifications of having a reserve currency over a long period of time. This actually is one of them. How do you fix that? You start rebalancing the global balance sheets on the trade and capital side.
What do we do in English?
I think
you said reshoring manufacturing.
Yeah.
That's underway.
You rebuild manufacturing, and you start bringing those dollars back home that used to go out. So if I buy something from China, I pay for it. They send that money to China. China pays their workers. They have excess. They recycle it back in U.S. assets, sometimes Japanese assets, sometimes European assets. As a reserve currency, part of what we do is we make sure that there's liquidity.
That way, because if they drove up the yen, then their stuff wouldn't be as cheap.
That's right.
Okay, then, and everybody's worried. One of the things people say is, the Chinese, they own all of our debt.
Yeah, well, they don't.
The Chinese have less than $1 trillion of that debt. Now, I'm going to also put it in perspective. The Japanese have about $1 trillion, right? So if the Chinese hated us and they wanted to sell that off, it would just be a blip in the treasury market. Now, the cent says, okay, I'm going to buy the long end and issue more on the short end.
That's right.
Okay, he called it the twist. So he'll save 1.5% in interest, and he could probably buy that below par value and reduce the actual debt.
So what this does, right, is you start flattening the curve. You got the low end or the short end of the rate cycle is high versus the long end. You bring the long end down, that gives room for the Fed to lower rates on the short end, re-steepening the curve. We're just changing the shape at a lower level, and that makes financing cheaper and kind of supercharges the economy is really, I think, the thinking around that.
All right. Now,
Grow your way out
what
of
does
it.
it mean?
Grow your way out of it.
Well, we're about to cover that too.
Yeah.
All right. Now, here, this is duration risk. Okay.
Okay.
So Stephen did the research. Stephen Norris, Super Chuck Norris, a wealth manager here at McGowan Group Wealth Management. Back in 2020, the yield on the 20-year Treasury went below 1%.
Yeah.
Because everybody was scared since we had the flu.
That's right.
And anyway, what happened here, you can see that the value, this is duration risk on steroids, the value of the 20-year Treasury bond ETF, exchange traded fund, low cost, it represents 20-year Treasuries. Well, if interest rates are zero, you divide any cash flow by zero and you get infinity. But the value was 170.
Yep.
Now, if I think, okay, everybody's got the flu, the economy shut down, I think I'll just buy treasuries. But I'll buy the long treasury because this one looks like it was doing the best. Well, I went from 170 to 82.
That's a lot.
How am I doing?
That too.
I don't care about the little bitty interest I got. I got walloped.
Yeah.
Right?
You're going to have to hold that a long time to get your money back.
Well, if you own the actual bond, you'd only have 14 years left.
Right.
That's called convexity, right? You get an advantage from the passage of time and a discount, but you didn't get a discount. You paid a huge premium. Don't do that. That's why you need a good wealth manager. And here, let's combine these, all right? These treasury bond holders are clearly not very happy.
No.
Here's a message though. If I go back 50 years in financial history, I've been doing this 40 years,
Okay.
all right? And I've seen the cycles. One of the big cycles, 1999, the Fed tightened and this treasury went to 6%, right? For 20 cents on the dollar, you could buy a treasury that would guarantee the whole portfolio, 25 years out.
That's called a zero coupon bond.
And there'll be a point that we would want to buy those. And I'll tell you where it is.
Yeah.
Okay. Now let's talk about the unfolding of the debt crisis. What is this? Household net worth.
That looks like 183 trillion to me.
183 trillion. So the government has 40 trillion in debt, US Treasuries, and 183 trillion is the net worth of US households, and that's after subtracting debt. So that's the net worth. All right. 25% of that, call it $45 trillion, is in real estate. Another portion is retirement funds, pension plans,
Right.
and just liquid assets. And then you have what we'll call collectibles, right?
Yeah.
So, but real estate's about 45 trillion of it. The rest of it, call it 140 trillion, at some price, just like you and I would say, you give me 6% guaranteed in a zero coupon bond because of convexity capital gain potential, I just hedge the next recession,
Right.
right? I learned that at Wharton. So I pull
Fancy.
rank and tell you that. Anyway, but some portion of that 180 trillion needs to be in treasuries for the Treasury to finance their debt. That means that the right number, it could be 5.24%. All right? Could be. I think at 6%, we would start to utilize, we would start to loan the government money at 6 or 7.
Yeah.
Now, that would be a painful correction along the way.
Sure.
The net present value of future earnings would be impacted because treasuries are competing. But at some point, and that's what's happened in every one of these crises, is the Treasury finds an equilibrium, and sometimes it'll smack the Dow or the S&P by 10 or 20% on its way there. So get some dry gunpowder is the portfolio management
I was about to
technique.
say, tactical safety becomes more important.
Congratulations, United States households, including all of us.
Yep.
183 trillion. So there we go. Now here's another solution.
Great growth.
Tell us about this chart.
4% is the third quarter GDP estimate by the Atlanta Fed, GDP Now, which
They take all the data every week from
Yeah.
across the country.
it's an algorithm. It's not an opinion, right? So they're not just making it up.
They don't just make stuff up,
Right.
right? Like Walmart this week goes down 10% in one day.
Yeah.
And the narrative, this is one reason you want to tune in and subscribe, because the narrative in the financial media, 40 trillion in debt, run in circles, scream and shout, right? Okay. And then Walmart comes out, and it was like, you would have thought that it's a recession and sales at Walmart actually went down.
They didn't.
No, it was the slowest growth in years, but it was 2.6% growth, same store sales as last year. Now that's less than inflation. You could call that kind of recessionary, but it wasn't a contraction in Walmart earnings.
No.
In fact, this says the economy's just fine. Now, if you stop the data center thing, that would take away 2% by your estimate. That'd be 600 billion being spent on data centers this year.
That's right.
Take that out, you're only growing at 2. Well, 4 is double average. 2 GDP growth is average over the last 20 years. Now, we would say, what's the portfolio strategy? Because you think there's so much debt, they're going to have to monetize it, print more money, so the dollar's going to plummet. What did the dollar do this week?
Well, it went down a little bit, about 2%.
I didn't do a chart on this because it's not very
exciting.
exciting.
I'll just tell you.
It went 101.5 to 99. That's not an exciting chart. That's 2.5%.
No. But when I think of this in terms, if you look at the inflation cycles with growth, we had a big one in the 90s, right? Gold went up, but the Dow Jones actually outperformed that estimate. So when you have that kind of inflationary environment, you do want to make sure you're an asset owner, but you want to own great assets at a reasonable price. And so there's a way to be tactical.
What time period did you reference? You're talking about the late 70s?
No, it wasn't the 70s. Maybe it's I thought it was the 90s.
Okay.
I have to double check that. Don't quote me on it.
I'll tell you. Well, I'm going to cover the right hedge. Okay. So you say, God, I'm worried the dollar's going to plummet.
Yeah.
Which would make sense, except for the dollar's right about where the index started in the 1970s versus other currencies. Started at 100, went as high as 160, went as low as 80.
Yeah.
But we're just right where we started, and it's not in free fall. That's part of it. But I think, oh man, I need an inflation hedge because the government's going to have to print their way out of it. Well, they can't really afford to tighten. That's one thing. So yes, you'll have inflation. Inflation's averaged 3%, 3.3% since 1913 over any reasonably long time period and over that time period. So 3.3% inflation means I got a hedge. Well, one hedge is dividend companies. All right. There's crude oil, right? So those companies pay dividends, 86.37.
Yeah.
1 billion barrels came out of storage because of the Iranian situation. All of Russia's refineries essentially are offline now. That's 7% of the refining capacity. So what happened? Well, first, we know there's an extra 1 billion barrels essentially that needs to get produced on top of demand to put storage back at where it was.
Right.
Wow. So that's an extended period of flow through the pipelines and energy infrastructure. Whoa.
Crack spread.
This is what you get, what you make in profit. If I refine a barrel of oil, what do I make in profit? The Russian reference that I just made is the reason for this big spike, because it was right in here that Ukraine began to disable all the Russian refineries with the new Flamingo drone.
Right.
Right?
That person's famous now.
Oh, she is. We'll tell the story of Irina. If you go to networthradio.com, you can see the podcast. And we wrapped it up with the story of Russia's newest likely billionaire.
Or Ukraine.
Ukraine.
Right.
Sorry. Thank you. I really messed it up. But all right, $60 for every barrel that you refine into refined product. And inflation hedges, sometimes if you own great assets, just a company that pays a dividend.
That's one for
those
sure.
Assets, if the company makes progress, they're likely going to be more valuable in the future, plus the dividend. And the S&P 500 13% year to date. Well, that's more than inflation.
Well, show us the other one. Oh, that's the one I wanted to see.
I like this one better. This is the S&P energy sector year to date up 45%.
Yep. That includes the infrastructure, the pipes, across the spectrum. What's really interesting about this is that if you go back 5 years, this sector was so stinking cheap, you're basically paying half the price of their infrastructure that they currently had.
We were covering that on YouTube.
Yeah.
Like if you were a subscriber, I was even showing, it's not a recommendation for your portfolio until you actually go to the McGowanGroup.com and get an updated wealth management plan from the team that cares. But we were covering it back then. And we were saying this stuff is 3 times cash flow, 5 times cash flow.
Yeah, it was so cheap.
It woke up before Epic Fury. Somebody knew because all the defense companies went up before, right after the 12-day war, supposedly last year, the 12-day war. Between that and February 28th, there's the defense contractors went to record high, and so did energy.
Yeah, but
and then here, whoa, that was even better.
I think part of when we look at our investment process, right? We don't have to know that that's coming. What we do need to know is, hey, this is a great asset that's trading way too cheap. It's going to pay us tons of cash flow.
Yep.
And that cash flow pays the bills while we wait.
Oh, and last thing I got.
Okay.
All right.
Last thing.
So I've always thought that was the best inflation hedge because we did the charts.
Right.
A long time ago. And there'll be a time that we probably harvest all or part of it for something else. But we got to have something better. Might be a 8% treasury. Right? I'll take 8% instead of that. So this past month, every client got a tax summary. Now, this is part of the wealth management process. People think, oh, I got to get a plan. Well, no, more important is your process. So we used advanced applied technology. We'll call it that.
Okay.
I could say AI. And that sounds fancier, but it's very intimidating. So we'll just call it evolving applied technology. We did a tax summary for all our clients for mid-year that said, here's your realized gains so far. Here's the income from the portfolio for just your taxable accounts. And we uploaded it to the secure document vault and client portal for the CPA as well to trigger the CPA so that you can do your tax planning early this year in the summertime when the CPA is happy. And to me, that's one of the best features of wealth management is a proactive process that makes your life easier, including the tax planning.
And there's always a plan that comes with our process. That's the front end of the plan. It's a living, breathing document that gets updated periodically as things change.
And on estates, we're the ones you want on your side when you're gone.
That's right.
Because we know how to keep the heirs from fighting. All right. Thanks for tuning in. We'll be back next week. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the longer play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.